This video tutorial is going to look at investment appraisal in an exam context. It's the first of a two-part video. In this part we're actually going to look at the question and some information that's in the exam. Beautiful cliche is that all the answers for the exam are actually given to you in the case study and the appendices. So we're going to have a look at that. So you turn up in the exam, you're sat there, you're hopefully quite happy, you've got your pens, everything all ready to go in your calculator, and turn over, and this may be what you're faced with. I've just pulled out here some snippets that are going to be useful for us. A key tip I would say is take a highlighter into an exam and actually colour code for different questions, or have your own particular style of doing it, but pick out information you're going to need. Some of it, even for finance questions, will be in the case study, some will be in the appendix. So we have a business called Snazzy Tech who make accessories for the tablet computer market, so things such as cases, bags, whatever. The company's losing market share, and the companies losing market share are either beating them in terms of quality or maybe cheaper products. So they're losing out, so we've got business in some form of peril, and this is pretty common. The new owners who've taken over the business are trying to basically look at cash. If cash had been an issue in the past, they almost became insolvent last year, couldn't pay suppliers. So the two machines they're looking to invest in, choice of one or the other, to help them to move themselves forward as a company. So machine A, information is here. You might want to pause the video just to have a look at some of the key information, make notes of yourself. But machine A really looks at quality and increasing that. It does require a bit of outlay. It's a more expensive machine, as you'll see, but hopefully it'll be useful in terms of addressing the quality side of things. Machine B would increase productivity, so that might suggest lower quality, perhaps cheaper products. So we don't know. Obviously we know a bit about the competitors and where they're losing out already. Board of directors have actually stipulated some targets for investment appraisal. Anything the company invests in must pay back within 4 years, must have an average rate of return of at least 3%, and a positive net present value. So what have we got for our different options? Proposal A requires an outlay of 80,000. We're assuming the company can borrow this, can access that sort of sum of money. 80,000, and you've got the inflows and other information here. And proposal B would cost you 60,000, slightly cheaper, and here's the information for that one. Discount factors, again, we'll see when it comes to the question in a minute, might be useful. Remember, they're always given to you. You do not need to learn them. That would be absolutely crazy. So finally, what is the question you've got? Using investment appraisal, which of the options available to the business would be the best to pursue? And this could be an 18-mark question, obviously evaluation in this one as well. So I'm going to leave you at this point. Please go back, have a look, pause the video, take stuff out that's going to be useful. Work on it. What I will do is then upload a full worked answer using any of the investment appraisal techniques, as well as thinking about some of the qualitative aspect of this question. Good luck.